So there's a problem with the economy, and we're all familiar with it. The economy is in recession. This means that the nation is producing fewer things than it could, and that it is not at full employment. This sort of thing is part of the business cycle and is expected to happen every once in a while. It's hard to predict, and despite what economists would like to think, most recessions come about unexpectedly. There are two types of approaches the Fed takes to combat this underproduction in employment. The first is monetary policy, which is the way the Federal Reserve changes the supply of money to affect the economy. Contrary to popular belief, the Fed does not have direct control over the economy or the money supply. Rather, the Fed has three tools to influence the supply of money, and in turn, the interest rate. These are the required reserve ratio, the discount rate, and open market operations. The required reserve ratio is the percentage of assets that banks must keep on hand at all times. While this requirement is there to ensure that banks have enough money for their customers to withdraw, it can be manipulated to influence the money supply. The Fed uses this to control interest rates and therefore aggregate demand. The discount rate is the interest rate at which banks borrow from the Fed. When the discount rate is high, banks cannot borrow as much money, and consequently make fewer loans, decreasing the supply of money and hurting the recession. The most heavily used tools of monetary policy are open market operations. The Fed buys and sells government securities, such as bonds, to affect the money supply.
Fiscal policy happens just down the road from the Fed at the Capitol building. There, Congress tries to affect GDP with legislation. There are two tools that Congress uses with fiscal policy: government spending and taxes. When spending occurs, aggregate demand increases because the government is directly contributing to economic growth. But government spending can crowd out private spending. If the government builds more public schools, the same number of private schools might go out of business. Crowding out is very circumstantial and does not always occur. When taxes are lowered, people have more disposable income, but they won't necessarily spend it. They might save it, pay off debt, or buy foreign goods. So between monetary policy and fiscal policy, which is better? Well, that depends. Monetary policy is fastly implemented, but has a slow effect on the economy. Fiscal policy is slow to be implemented, but has a fast effect on the economy. To really get out of a recession, both monetary and fiscal policy need to be used in conjunction. The best way to fix the economy, however, is time. With automatic stabilizers, the economy will gradually return